Good morning. Welcome to Trading Hour. With me is Surbhi Upadhyay. I am Reema Tendulkar in the red now for the benchmark indices. After opening higher, the Nifty opened around 22,300. It's given up about 150 points from the day's high. So that's a bit disappointing. But midcaps are holding on tightly to all their gains. The midcap index is up 0.7% with the advanced decline ratio in favor of the gaining side. Hi, Surbhi.
Hi, Reema. It's again those PSUs, right? In the mid-cap universe, that seems to be one island of green. But on the large-cap screen, it has been a bit of a disappointing morning. No, two ways about that. That's the advanced decline ratio, still positive, but those lines are now beginning to get a little closer. So let's see how it plays out. But for the large caps, this is disappointment. I mean, we've gone through a long period of consolidation now throughout this week and the better part of last week as well. And that attempt of a bounce didn't really succeed above 22,300. And again, we are at the lower end of the trading range. The declines today, some of them are coming in from the auto space. A lot of auto stocks are looking at profit taking, whether it's Maruti, Eicher, Tata Motors, Bajaj Auto. So auto as a entire pack is fairly weak. We'll just pull up some of the stocks there for you. Yeah, Maruti is, of course, actually the biggest loser on the index, down 2.5%. But the entire set is actually weak. And then if we pull up the Nifty contribution chart, that will tell us that a lot of heavyweights are also dragging today. Now, whether it is some of the banking names like SBI, whether it is something like a Lever, whether it's Reliance itself. So a lot of the big boys are on the, on the downside. And Reema, it's only, I think, some of the tech titans that you track and Bharti, that's pretty much bringing up the green end today.
Well, even on IT, it's not that there is any news. It's just probably the rub-off impact of the 1.5% rally that we had on NASDAQ, which is fueling the up move in IT. Because other than that, there is nothing which is driving up, the gains for IT. But Bharti, now that's a different story. The Bharti reported their numbers on, Tuesday post-market hours. So yesterday the stock opened up in the green, but the conference call, the investor call was at 2:30 p.m. And what the management had to say in the investor call has provided, another dose of confidence for investors. So in the investor call, the management is batting for tariff hikes. So let me tell you what what the management had to say. He said that tariffs in India are at absurdly low levels compared to anywhere in the world. Tariff repair is needed in the industry. And we will need significant tariff repair. And even if ARPUs go up to levels of 300, and currently they're less than 210, even if ARPUs go up to 300, they will still be the lowest in the world. That said, it's not that he commented a tariff hike is coming. If it does come, when it's going to come, and what the quantum of the increase could be. But I think the street is reading this positively, right? And the fact that, Vodafone Idea has gotten capitalized now, they've raised some money, which means that Vodafone Ideas, needs to survive and thrive, we will need tariff hikes coming. So JP Morgan has upgraded Bharti Airtel to an overweight and raised the target price to 1,500. They're saying that the industry focus, which from 2016 to now, was more about gaining market share at the expense of others, right? Undercutting, price erosion, and gain market share. The focus was on volumes. Yeah. But now they're saying it's going to shift towards monetization, which basically benefits all of them. Kotak has also raised the target price to 1,410. They're saying, yes, Bharti Airtel has been an outperformer, and valuations today are higher than the valuations Bharti Airtel has typically enjoyed. But even at these levels, they believe the risk-reward is favorable. On Vodafone Idea, Kotak has once again initiated coverage, but with a sell call. The target price is 10 rupees. But what's interesting here is the risk reward is a little favorable. The skew is more in favor of risk because their target price is 10, but the bull case is 23 and the bear case is 7. So your worst case is that, the stock goes to 7 rupees from current 13 rupees. But your bull case is it goes up to 23 rupees. So
23 is the bull
23
target.
Is the bull target. So the risk reward is high and it's skewed in favor of perhaps risk. On tariffs, Kotak says that the first tariff hike should come post-elections of close to about 20%. And after that, in just about 15 months, in December of 2025, the next tariff hike should come.
24 or 25?
No, so okay. June 24 onwards is the first tariff hike of 20%.
Okay.
18 months after that, December of 2025, should be the second round of tariff hike, and that could be to the tune of about 15%.
Okay, so, well, that's the hope, which seems to be keeping some of the telecom stocks afloat for sure, and Bharti doing really well in an otherwise weak sort of a session. So that's the large cap space and what's moving, what's working and what isn't. Now let's talk about mid caps, because we've been telling you that it is the mid cap market, which is where we're seeing plenty of green. And one of the stocks that's really catching the eye is Somany Ceramics. Let's pull up Somany. Last time I checked was some 14% higher. I think even now the gain is actually 15 to 16% higher on Somany Ceramics. Numbers came out yesterday. Top line, I think, was up about some 7-8%, but the real move has come in at the EBITDA line. Let's go across to Mangalam to find out what's happened. What's the kicker? What's the trigger here? This is a big move, Mangalam.
Well, at the same time, last year, we were all quibbling about why the margins for all these tile companies are going down. And that time, everyone was saying, okay, gas prices are increasing, fuel prices are increasing. That's leading a compression in the margins of all the tile players. And now that is coming undone. In fact, gas prices have come down from the highs, and that's reflected in their power and fuel expenses as well. So if you look at it, the top line, it's grown about 8.5%, 737 crores. The EBITDA has jumped because power and fuel as an expense, has reduced year on year despite an increase in top line, and that means as a percentage of sales, the delta here has been nearly 400 basis points. So 23% of sales earlier was power and fuel expenses. With the reduction in prices, it's come down to just 19% of sales, and that's nearly led to a 200 basis points improvement in their overall margins from 9% to closer to 10.8%. And, it's also led by volumes. The fourth quarter sales volumes increased by 7%. And that's higher than what we've seen in the first 9 months of this year, because despite a 7% jump in the fourth quarter volumes, for the year, volumes have grown just about 5%. So that's telling you that operationally, things are looking a lot better, and also directionally from a demand standpoint, things are a lot better as well. Though the company doesn't only allude, lower or stable input costs to their margins, they're saying that it's also led by their own cost optimization efforts, and operating performance of some of their joint ventures too has improved. So that is expected to even give better results going forward. So, the street likes the fact that demand is improving and operations are looking a lot better. Anything that the management has to say with regards to improvement in the future is being lapped up. That's the kind of market that we're in right now. Earlier they were under pressure. Now the pressure is coming undone, and that's why the stock is up 15%.
Thank you for explaining that. Let's move on and talk about Oberoi Realty. There are some brokerage notes from Motilal Oswal and Jefferies. Sonal joins in with the latest. Sonal.
Thank you so much for that. Well, Oberoi Realty reported numbers day before yesterday. It was a good set, and brokerages post the conference call have written on the stock as well. Most of them have neutral or underweight trading because of higher valuations, but the management commentary has been positive. Motilal Oswal has a neutral rating with a target price of 1435 rupees a share. The company, they say, is mindful of significant cash flows that can be generated from existing developments, and they intend to deploy the cash in prudent way as well. There is no dearth of opportunities according to the management, but it is very crucial to sign projects which are aligning with their capabilities, because they call themselves quality developers in the luxury market as well. Jeffrey says that the strong response to the new launch at the flagship Garden City Township drove pre-sales jump this time around, and this jump came in after quarters of underperformance versus the peers. Medium-term project pipeline now includes new locations in Thane, Gurgaon, Worli and South Mumbai as well. So they are coming up with newer projects in different geographies in Mumbai itself. Execution will likely remain steady as management focuses on quality delivery. Customer collections were higher, 21% on a quarter-on-quarter basis, 24% on a YY basis, and free cash flow generation was also very strong, something that the street seems to like. They build in pre-sales growth of 20% each for FY25 and FY26, and they have a target price of 1548, but they have a hold rating on the stock.
Okay, all right, got that. Oberoi Realty responding really well as well to a lot of those views. Sonal, thank you for it. Let's move on and also track Apollo Tyres. Now, Apollo Tyres is another stock that seems to be responding fairly well to some brokerage notes that have come in. Sonia is here with more details. Sonia, so what is the view post numbers now on Apollo?
So, there are multiple upgrades that have come in on Apollo Tyres post the numbers, and let me take you through them. Nomura has upgraded to a neutral. They have a target price of 512. JP Morgan has upgraded to an overweight. They've raised their target price to 555. And Morgan Stanley has an equal weight with a target price of 472. Couple of reasons why brokerages have upgraded the stock. One is the company continues to demonstrate commitment towards balance sheet deleveraging. Reducing their debt is the key focus area for Apollo Tyres right now. The second thing is the valuations currently at about 6.5 times FY26 EV to EBITDA. It does not look that expensive compared to some of its peers as well. There is a proactive approach that the company has to price discipline, and now there is limited capex intensity. Hence, that will lead to higher free cash flow for the company, which will eventually lead to a better balance sheet. So lots of positives coming in for Apollo Tyres, and hence multiple brokerage upgrades there as well.
Okay, thank you very much for that. Apollo Tyres was up 6.5%. But now some of the gains have come off, 3.5% up on Apollo Tyres. We'll get into a break. We'll discuss commodities on the other side with Manisha Gupta.
Welcome back. Let's now shift the focus to the commodity universe. We have Manisha joining in, and today she is looking at precious metals. Manisha, good morning. Good to have you on the show as always. So tell us, what's the latest here?
Well, yeah, we have seen gold and silver back glittering yet again. I mean, there was some profit taking in the last 1 month or so, but we're looking at stronger gains coming back. If you look at the gold prices, we're back around that $2,400 per ounce mark. That is because, one, the US dollar has declined a bit, and that has happened because the US inflation data is lower than what the street was anticipating. Even the US retail sale number for the month of April have cooled down a bit, and that has led to a 72 to 74% probability that you might be looking at the first US Fed rate cut coming for the month of September. Now that really has the bulls coming back in case of gold prices there. Add to that the fact that the global central bank buying has been strong. In the first quarter, even as the gold prices were hitting all-time highs, we've seen global demand gain up by 3% and Indian demand gain up by 8%. For the month of April as well, at all-time highs, we've only seen gold imports into the country continue to gain up. Chinese buying has been on the stronger side as well, so much so that even at these higher prices, the China gold prices are trading at a premium right now. But not just gold, the silver global prices are now trading at around 3-year highs, very close to those 11-year highs as well. Overnight has been 3% of gains for silver, and for this month now we are trading almost 7% up for silver prices. It's trading at around 11-year highs in the international markets, but for the Indian markets, it's an all-time high that you have for silver prices at around 86,000 rupees per kg, and markets do believe that once the smaller correction already being done, from here on you could be looking at higher highs for these.
Thank you, Manisha, for that. Get into a break. On the other side, we'll invite the management of Transport Corporation of India. It's buzzing on the back of its Q4 numbers. We'll get chatting with the management. Stay tuned. Welcome back. Let's talk to the management of TCI, Transport Corporation of India. The company reported the Q4 numbers. Now, in Q4, the company's managed to report a double-digit revenue growth, but Q4 is typically the strongest quarter. For the full year, though, the top-line growth is limited to 6.5%. To talk about the way forward, the margin outlook, we have Vineet Agarwal, MD of the company, to take a few questions. Vineet, morning. Thank you for joining in. This is Reema here. First, if you could guide for FY25. FY24 was a 6.5% top-line growth kind of a year. What should we expect in FY25 on revenues, margins, and what would be the key drivers?
Hi, Reema. Good to be back. FY25 looks a lot more exciting than FY24. I think at the start of FY24, we felt that things were slowing down a bit. And we did maintain a aggressive 10% top-line growth, but that didn't happen. We did correct in the middle as well. FY25 looks exciting because I think with whenever the new government comes in place, we'll definitely see a lot of activity there. Certainly a lot of spend on infrastructure that is going to keep increasing, which has a direct impact on logistics as well. And we are guiding for about 10 to 15% again on the top line and the similar on the bottom line. It is, and a lot of other sectors will also start playing up with, the manufacturing PLI schemes that is going on. We are seeing good traction from there. A lot of companies now starting production as well. Automotive sector continues to do well. Might be a bit of a slowdown, but there are lots of other areas in the automotive space that seems very, very attractive.
So you're saying, if I could get that again, about 10 to 15% growth at the top line and at the PAT level, Vineet, if I caught you correctly?
That's right, yeah.
For the year as a whole. Let's also talk about margins, because if we look at margins across the various verticals, there is a bit of a dip on the freight side. Margins, Mangalam tells us that they've come down from about 4.2 to 3.2%. Supply chain is more or less steady. So just tell us about blended margins. What can one expect this year and how the individual segments are performing?
Certainly, the blended margins should also start improving. With the freight business saw a bit of weakening this year as a whole because there was a bit of competitive pressure as well as the freight rates did move around a little bit here and there throughout the year. But going forward, I think the margin expansion continues to happen because we are adding more value-added segments. Our supply chain business, which is amongst the higher margin businesses, will grow more aggressively than the freight business. Our seaways business also, which has a higher EBITDA margin, will also grow in this year. And even in the freight business, the mixed change is starting to happen where we are moving more from the FTL to the LTL segment, which means that the margin should expand there as well. So going forward, all of these means that across all the segments with margin expansion, we should see an overall margin expansion. The companies also...
Can you quantify that? Vineet, sorry to come in over there, but can you give a rough range? Can you roughly quantify what is the kind of margin expansion at the blended level that you would hope to achieve in FY25?
I would think about a 75 to 100 basis point improvement on the numbers should be there.
Okay, so I believe earlier you said 10 to 11% is a range. Now, are you saying it could be 75 basis points above 11%?
It could be around the same 11-ish, 11.5% range.
Okay. And you've said for seaways, for instance, the margins are higher. Is it possible for you to break up the margins across the various categories for freight, seaways, supply chain, etc.?
Yes. The freight business typically operates at about 4.5% EBITDA. The supply chain business about 10-11% EBITDA, and the seaways business at about 40% EBITDA. So there we will see some amount of movement in every single area. In net, as I said, about between 11-11.5% is what we're looking at overall EBITDA margins for the year. We also have no debt on our books. We have surplus cash. We're sitting around 400 crores of cash. So that also means that there's no interest cost. It's mostly a lot of depreciation because we have ships and trucks, which are high depreciable assets. So that continues to increase the EBITDA margin as well.
Vineet, just another question on Seaway, since that is the higher margin business. To what extent do you think you can grow it as a percentage of the total revenue pie? Where did you end FY24 at, the contribution from Seaways, and how much higher will it be at the end of the current year, FY25? And if you could just tell us, what are the routes on which you're operating, how are freight rates looking, and what's really happening there?
So it's a very interesting business. We operate only on the coastal waters of India. We operate on the west coast as well as on the east coast. We have 2 ships on the west operating from Kandla to Cochin. And of course, we stop en route at different ports. And on the east coast, we operate from Chennai and Vizag to Port Blair. And these are 6 ships. We own these ships. They're about 80,000 deadweight tons in total, and we have about 8,500 containers. We move everything in that. From ceramic tiles to cotton to even general food items. Now, the business has a potential to grow rapidly, but the capacity is a problem for us. We typically buy ships from the second-hand market, and with the Red Sea crisis that's going on, availability of ships is just very, very little. And we've been trying for the last year and a half to really look at an acquisition of ship, but we've not been able to find something. We, in fact, went ahead and ordered brand new ships also to a Japanese shipyard, which had to be cancelled because they were not able to fulfill the obligations. And we are now looking for buying 2 more new ships as well. So this is still work in progress, but coastal shipping is only 6% of the movement that happens in the country, of the freight movement. In China, it is close to 20-25%. And as a country, if we have to really bring down logistics costs, we need to move towards the coast. Of course, move towards rail and the coast as well. So it is an imperative part of the business.
You said you're planning to buy 2 more ships now. You've been struggling to add capacity, in Seaways, but now again you're in talks to add 2 more. Do you think it can happen in FY25? And will FY25 growth be similar to FY24 in the absence of any increase in capacity?
I'm a little less hopeful of adding capacity in this financial year because the crisis doesn't seem to be getting resolved anytime soon, and pricing is not coming down for second-hand ships. We might place the order for the new ships, but that will anyways get delivered more than 2.5 years later. So,
Okay.
so yes, I don't think any capacity addition will happen per se this year. We are hopeful for something, and that will not impact the business revenues or profitability.
Since you did mention that, I mean, intrinsically you want to add more ships, let me just talk about the overall capex plan as well. How much are you looking to deploy this year, and what are the cash levels like?
So we are looking to spend about 375 crores, which means that about 125 crores will go into new facilities, warehouses, the like across the country. About 100 odd crores, 125 crores into new trucks and rakes. We own some automotive rakes, railway rakes, which we plan to add more. And then, of course, the ship, if there is a potential to add something, then another maybe 7,500 crores there as well. We are, as I said, zero debt, so we have 400 crores cash on our books, and we can, but we will borrow if need be, and we have the capacity to do that.
Okay, we leave the conversation here. Thank you very much for joining in. Transport Corporation of India more bullish about FY25 than they were at the start of FY24 when they thought things are slowing down. They ended FY24 with a 6.5% top line growth, but for this year, they're looking at a 10 to 15% top line and bottom line growth. Get into a break. We'll discuss market technicals. Vishal Malkan joins in on the other side.
Welcome back. You are with us on Trading Hour. Let's focus on some more stocks that are reacting to numbers. Now, another green reaction we have is from Honeywell Automation. Let's go across to Sudarshan to figure out what's worked for this one. Sudarshan, very interesting reaction because the stock opened negative, and now I think the market is coming around to believing that the numbers were actually good. Tell us more.
That's correct. So if you have seen the opening, it had opened with a cut of almost 6%. From there, it made huge recovery, and the last time I checked, it's up 5%. That means it has recovered almost 12% from the intraday low. Now coming to numbers, revenue has missed estimates, while EBITDA and margin were higher than estimates. Revenue missed estimates by 4%, but it's up 12% year on year. Margin has come in 200 bips higher at 17.9%, and both margin and profit are at multi-quarter highs. Now coming to brokerage's views on Honeywell, Nomura maintains buy rating, and it has raised target to 53,600 from 46,100. It says revival in real estate, healthcare and hospitality to push demand for building automation, and company is well placed with its holistic offering for renewable sector. Also, company can provide comprehensive automation for PV cell factories. And considering all these, it has raised P multiples to 60 times from 55 times on sectoral tailwinds, and it expects margin to recover to 15.6% by FY26 from 13.8% that company saw in FY24. So overall, earnings were in line or slightly higher than Bloomberg estimates.
Thank you very much for that. It's a solid intraday recovery. Thank you, Sudarshan, for that. Vishal Malkan is now with us on the show. Vishal, a bit disappointing, right? The morning highs could not be held on to. The Nifty slipped about 140 points from the day's high. What have you made of the day? So actually, it's more than a 200-point fall now from the day's high. What have you made of the way the morning has progressed? And what would your stock calls be?
I would say that Nifty and Bank Nifty are caught up into a range which is 22,000 and 22,500 for Nifty, and Bank Nifty would be around 47,300 and 48,000, which is very tight range. And maybe we are waiting for some kind of news and some kind of announcement or some kind of exit poll coming out of the election. But I would, at this point, I would go more stock specific where we have clear breakouts and clear momentum. The first stock, which I think is my favorite as of now, is Ashok Leyland, which has broken about that resistance of 200, and it's a cup pattern on the monthly chart. So I'll go with the buy on this with a stop of 198 for targets of around 225 and 245. And the second one would be Jindal Steel, again, in momentum, breaking above that resistance of 980 and continuously trading above that with volume. So stop of 980 for targets of around 1,040 and 50.
Okay, all right, Vishal, got that. Thank you very much for the details there. Vishal, just another quick follow-up. There's a lot of selling on auto stocks today. It's almost across the board. Any sense you make of it? Are you taking any trades in auto at all? And M&M also reports numbers today, so maybe a view on that stock?
I think, M&M, I would look at as it has a stupendous move in the last few months, and it's the kind of pattern which is forming today is just a simple small profit booking thing. So I don't think it's a major decline. Although Tata Motor has seen some great decline in the last few days with the gap down opening. So I think that stock has gone from a strong uptrend to a consolidation mode, but M&M is still bullish.
Okay. All right. Thank you very much, Vishal, for joining in and giving us a couple of those trading views. We will take a quick break on that note, come back on the other side, and we'll discuss market fundamentals with SBI Securities' Sunny Agrawal in just a bit.
Welcome back. Let's now focus on, the mutual fund corner now. So, Surbhi, at the beginning of the year, there was some tightening done on the KYC norms, right? And people are still wondering whether the dip in the April equity flows was linked to that.
Yeah.
Well,
the industry claimed no, but
the
that's
industry
a separate
claims
debate.
no, but there was a dip that we saw in the April equity inflows. But now I think the latest is there is some relaxation on the KYC norms. So first, tell us the background and then the update.
Okay, so what happened was starting from the 1st of April, there were 3 KYC buckets that were created. One is KYC validated, and that became the holy grail, that everybody should have a KYC validated status to ensure seamless transactions, buying, selling across different AMCs. Now, not everybody has that KYC validated status. Some people do. The second was a KYC registered status, which a lot of investors, I mean, the bulk of mutual fund investors are already KYC registered, but may not be KYC validated. The third category was a KYC on hold status. And it is this third category that caused the, furor and a storm. Because if you were KYC on hold, I'll get to the reasons why, then you couldn't do anything. You couldn't buy, you couldn't sell with your own AMC or any new AMCs. And that is why there was a huge amount of discussion on it. Now, AMFI sort of specified when the numbers came out, and I asked them that question, that how many people are impacted. Their assessment said that it's not a huge issue. Just about 3 to 4% of the total, mutual fund account holders are on KYC hold. But still, it could be, your father, mother, it could be an old gentleman, it could be someone who's not very digitally adept to make sure they move to KYC validated, which is the new norm, which is a new standard. So therefore, now there is a relaxation after a lot of back and forth from industry, from stakeholders. SEBI has offered a relaxation. So the good news first and foremost is that in the earlier norms, you needed to verify both your email and your phone number. Both had to work, both had to be verified. The AMC had to ensure that they can reach you through both channels in order for you to keep transacting seamlessly. But the first relaxation is now one is enough, either mobile or email. That's the first relaxation. The second major relaxation is that for investors where the status was KYC on hold, now at least they can redeem funds. Because, Reema, that was the big thing, that if you're KYC on hold, not only can't you invest further, you couldn't redeem your funds. If you want money, you can't sell and get out. And that, created a massive controversy. So at least that relaxation has been allowed. Last but not the least, for NRIs, it became really, difficult because the way to get KYC validated is ensuring you have an Aadhaar and your PAN and Aadhaar are linked. A lot of NRIs don't have an Aadhaar card. So for the time being, at least, they have been given a 1-year relaxation, 1-year extension. But, I've been speaking to a lot of people since last evening on this whole issue. And I think the sense in the industry is that this is a temporary relief. Ultimately, everybody has to move to KYC validated. There's no getting away. But yes, if you are KYC on hold, you can at least go in and withdraw and get your money back. You can sell your funds and get your money.
Okay, thank you for explaining that. But that's a very, very important update and relief coming in for mutual fund investors like you and me. But let's move on now back to the markets, talk about individual stocks. Sunny Agrawal from SBI Securities is now with us on the show. Sunny, morning, and thank you very much for joining in. What have you picked up from your circles about this recent volatility, this range-bound trade? Is it just election jitters? And what happens after we get the verdict? How do you expect the markets to move?
Good afternoon, and thanks for having me on the show. Definitely, I think a big event ahead of us, and as we speak about market, I think it has been a range-bound trading, what we have seen during the last 2 to 3 months. So 21,700, 800 on a downside, and 22,700, 800 on the upside. So I think 1,000-point band where we are seeing a Nifty trading. Nervous ahead of the big verdict, obviously. Let's see. I mean, I think the market is entering with a narrative that the current government policies and the current ruling party will continue. And to that extent, the earning growth trajectory, which we have seen a robust earning growth trajectory post-COVID, that will at least continue in a mid-teen for FY25 and 26. So I think we are hopeful, cautiously optimistic. Having said that, I think there are many sector-specific opportunities which exist in the market as far as the wealth creation is concerned from a medium to long-term perspective. Case in point, railway wagon is the one theme which we like. I think all the three major players, whether it is Titagarh Rail, Texmaco, Jupiter Wagon, sitting on a robust order book. At the same time, there is a strong tailwind from Government of India, wherein during the recent budget document also we have seen that government is giving push to increase the share of railway freight from current 26% to close to 45% by 2030. And to support that, I think many new dedicated freight corridors have also been launched. So I believe that ultimately the wagon as a subsector is which a wagon manufacturer will be the key beneficiary out of that. And all the three players, Titagarh, Texmaco and Jupiter, are sitting on a very robust order book. We expect the execution to pick up during next 2 to 3 years, and hence the numbers will catch up over there. Although at a current juncture, valuation may look pricey, but going forward, what I feel is that as execution pick up, at the same time as the new tenders are rolled out, we will see order book will also jump. So this is the one theme which we like. Another macro theme which we like is about the metal products. So all the metal pipe companies, whether which are supplying to industries like water, oil and gas, solar, high-speed rail. I think these are the few sub-sectors where metal product companies will benefit out of that. Case in point, all the ERW pipe companies are sitting on a robust order book on the back of order from Jal Jeevan Mission, solar torque tube, that's another big emerging sector, infrastructure. At the same time, we are seeing to cater to this increased demand, there is a capacity expansion which all the key major players have taken, whether it is APL, Apollo Tube. They are expanding capacity from 3.8 million ton to 5 million ton. JTL 0.6 million ton to 2 million ton in next 2 to 3 years. High-tech pipe 0.7 to 1. Good luck from 0.3 to 0.45. Jindal saw again, which is into LSAW, saw sitting on $1.5 billion order book. I think the entire metal product, whether it is in pipe or for that matter, wire rope companies like Usha Martin, which are again sitting on a very decent order book as well as capacity. I think the entire these metal product companies are in sweet spot and likely to deliver a healthy earning growth over the next 2 to 3 years.
Okay, so metals and some of the related companies, wire companies perhaps as well. By the way, I'm looking at some moves building up again. Just allow us 1 minute, Sunny. Look at ABB India on the move again, 3.5%. Look at Hitachi Energy again about 9.5%. GE T&D up again 5%. So this mega capital goods move, that's back on, and that's really been the story of the week. A lot of these stocks doing well. Honeywell, of course, we discussed with Sudarshan just a while back. It's also up about 4%. So yeah, industrials and capital goods stocks really ruling the roost. ABB India this week is up about 16 to 17%. What do you think of this sector, Sunny? I mean, we've had some pretty strong earnings. At least Q4 has been good for many of the operators. What's your take, and would you recommend any stocks on the buy side now?
Yeah, definitely. I think a very robust set of numbers from all these MNC companies, whether it is ABB or that for that matter, Siemens India. I think one of the subsector which we like within this category is the bearing companies like SKF, Schaeffler India. So we have seen again a very robust set of numbers from SKF as well as Schaeffler India. And I feel that ultimately the key beneficiary of the industrialization in India will be all these bearing companies, whether it is on automobile side or industry side. So SKF and Schaeffler is our topic. One of the small company on engineering side, that is Praj Industries, is also on our radar. So of late we have seen that there was a ban on direct conversion of sugarcane juice to ethanol, and that has led to some apprehension that whether Praj Industries will able to get additional order for this distillery segment. I think post-election this decision will be unwound, and I think Praj is trading at a risk reward seems to be very reasonable as far as Praj Industries is concerned. So bearing and small engineering companies like Praj will be our top pick from this sector.
You also like capital market plays, Nuvama, BSC, IFL Securities, Angel Broking. These are some of the stocks that you recommend in your portfolio. You know, the view is that, you know, the long-term story is very much intact. But these stocks have already front run and given, you know, the returns that, you know, for the next few years. The multi-bagger stage may be over, and from here on they'll do well, but not the kind of returns that they've already given in the past. Is it safe to enter any of these stocks at current levels for someone who's not participated?
Yeah, I think you are right that the first leg of re-rating has already been done as far as all these capital market stories are concerned. But I think the runway is pretty long right now in terms of even demat account penetration. We are close to 15 crore demat account right now. Even on wealth management side, I think the opportunity to tap the pull on ultra HNI and HNI categories humongous. So I think there is still a long runway in terms of growth as far as this entire capital market story is concerned. And one of the stocks which we like over here is the BSC, Bombay Stock Exchange. The reason being that I think yesterday only they have completed first year of relaunch of future and option product. And right now they are sitting on close to 7 to 8% market share. And going forward, I think there are many multiple levers which are available for earning growth. A case in point, launch of new products, shifting of expiry from last Thursday to mid Thursday for stock-specific expiry. So I think multiple levers are available. I agree that the story from here henceforth will be kind of 20% plus CAGR rather than looking at a multi-bagger return from all these capital market growth stories.
Okay, all right, Sunny, we'll leave it on that note. Thank you very much for joining in and taking us through some of the specific stock calls. Well, let's move on and talk about Mahindra & Mahindra now. Sonia's back with us because today is M&M result day as well. Sonia, in the morning you were telling us, I believe, the new one, right? Well, it's XUV 3XO, right? That was the refurbished launch. That's doing well. I wonder, what about the numbers?
Well, you know, as you rightly pointed out, the XUV 3XO saw phenomenal registrations, right? Over 50,000 bookings were registered in 60 minutes. So very, very good there. But let's talk about the numbers and what to expect. Remember, the stock is at a fresh record high. The stock has had a dream run in the last many weeks and months. It's up 33% in 2024 already. Now, there is a mixed bag expected this time around. So, while the auto sector was very strong, it is the tractor sector which has been under pressure. So, the auto segment volumes were up 13% year on year, but the tractor segment was under pressure. Volumes were down about 20-odd%. That will result in a revenue growth of just 6.5% for the company because the overall volume growth was just about in low single digits. On the margin front as well, we are expecting barely an EBITDA growth of 2%. The margins on a quarter-on-quarter basis will actually fall. Even on a year-on-year basis, we're expecting 11.9% margins. And on profitability as well, not too much of a growth about, in fact, the profit after tax is expected to fall by almost about 9-odd%. But as I said, the important bit to understand for M&M is what happens with the tractor segment. Auto segment has been firing on all cylinders, very strong growth in the SUV segment, but its tractor segment, which was down about 20% in year-on-year in Q4. But now with the monsoons situation and, a pickup in rural demand, the ask from the management, at least the expectation from the management, is that the commentary on the tractor side will be positive. So we'll wait by for that. But for now, expect a mixed bag in terms of earnings.
Thank you, Sonia, for that. We'll slip into a break. We'll come back with more. Stay tuned.
The RBI has tightened regulatory scrutiny of banks and financial service companies in a big way in the last few months. So does this make investing in the BFSI sector more risky? Well, UTI Mutual Fund CIO Vetri Subramaniam definitely doesn't think so. In fact, in the latest episode of Market Cafe, he explains why the BFSI sector offers some great investment opportunities at the moment. Take a look. RBI saying something on unsecured lending, RBI saying that, okay, project financing norms need to be tightened, you need to set aside more provisions because you need to create buffers, for the next cycle. Or individual entities. It could be a Paytm one day, it could be a Kotak Bank, it could be a small NBFC. The RBI is watching everything like a hawk. Hasn't this, completely opened up a whole new metric to track?
Sure. You're right. But again, it goes back to what I said, a little bit of that ambulance chasing. I mean, go back and look at what was the news flow in 2015, 16, 17. It was all about the asset quality review. It was the amount of NPAs that the banks had to, sort of start to recognize. And look, if you had acted at that point of time, the kind of returns you've been able to make since that period. Here, I would say if you think about RBI, maybe because we've already done so much on inflation and so much on, cleaning up the health of the bank books, that today the regulator is a lot more focused on issues related to technology and processes. But again, to my mind, this is actually an opportunity because if these people, get their act together, they're able to clean it up. And I think RBI has been quite a lot more onerous than they have been in the past in terms of taking actions against entities. I actually think it just ends up making the system a lot more stronger. Yes, individual entities may have a setback for a year or two. We heard Kotak talk about the impact, though they said it would be quite limited in terms of their ability to grow. But that's fine. We are playing the theme. Maybe for a year or two, some other bank will benefit at the expense of one bank. But I don't think it changes their medium-term growth prospects. And I think I just look at it as at one point of time, RBI's focus was clean up the bank books, monetary policy. And I think right now they're just saying, let's solve particularly the technology and fraud-related angles. And anything which makes the system secure is welcome. One final point over there, whenever you tighten these guidelines, actually, I always believe incumbents benefit. And remember, one of the unusual things about BFSI is one of the few sectors where entry is very difficult, particularly in banks. There is no new licensing, right? So it's tough for new competition to enter. So BFSI in India actually has a wonderful regulatory advantage, which is there is no free entry. Right? You want to start a telecom company, media company, mutual fund company also can be done. But banks,
you can't start a bank.
Yeah, you can't.
Right now, is there anything that concerns you a little more because they're going after banks and NBFCs where there's a a digital mismatch, right? Which was the case with Kotak. They're going after whatever compliances are not in place, gold financiers, what we're seeing. Then they're already looking at avoiding another bad credit cycle, which is where the additional provisioning perhaps kind of comes in.
Sure.
So because of this, is there any particular one sector or two sectors within BFSI which you think will be impacted a little more? So maybe, from an investor return perspective, or
honestly, no, I don't see it that way. And I think the most attractive part of this is the core banking franchise, because if you look at it, over the last 5 years, credit growth, deposit growth, more or less aligned with nominal GDP growth. Even if I crunch the numbers over 10 years, it will look the similar. If I crunch it over 20 years, credit growth historically has been about 1.2 to 1.5 times GDP. But go back and look at the middle decade of the 2000s, credit growth was actually almost 2x of GDP, right? So if you're talking about India's sort of growth rate at 6.5% in nominal terms, maybe 10 odd percent, in real terms, 10 odd percent in nominal terms, it's very easy to see credit in India growing at somewhere between 12 to 14% per annum over a sustained period. Now that creates a fantastic backdrop for the banks to actually generate profitability. And when we talk about all these things in terms of income levels going up, companies wanting to do capex, it's actually a wonderful environment for the banks to go out there and being able to lend money to people who are wanting to borrow because their own standard of life is improving, their incomes are improving.
All right, so that is Vetri Subramaniam talking about specifically why, though he's very cautious on the market overall, by the way, and now we also dive into that, but why he thinks BFSI still offers plenty of opportunities and gets into, of course, individual facets of BFSI. That's the latest episode of Market Cafe, and it'll be dropping on YouTube tomorrow, Friday. So remember to check out. Of course, we'll keep playing some more excerpts as well as we release the show on YouTube. Rima, over to you.
Okay, but with that, we're going to wrap up on Trading Hour, but we leave you with a nice interaction between the finance minister and the broking community, which took place at the Bombay Stock Exchange earlier this week. You know, this is a question which is put forth to the finance minister by this gentleman, and it's something which will resonate with the vast majority of the market participants. Listen in, and thank you for watching this show.
I am Praful Shah, Pilot Capital. Madam, I have a very funny question for you. As a broker, when we are putting a trade for retail investor, we are attracting number of taxes, CGST, IGST, stamp duty, STT, long-term capital gain tax. So today, Government of India is earning more than the broker. We have... So, I am investing everything, I am taking whole lot of risk, and Government of India is taking away entire profit of mine. You are my sleeping partner. I am a working partner with my finance, my risk, my staff, everything. So what do you want to say on this? Number two, there is one more question for you. You have removed cash component, Mr. Lodha is also there, from buying a house. In Bombay, today, if anybody wants to buy a house, is a nightmare. Because I am paying tax, I have white money. Now we have to pay everything by check. Mr. Lodha will not accept cash. So, my bank balance is purely after paying all taxes to Government of India. Again, when I am buying a house, I have to pay stamp duty, I have to pay GST, so that amounts to 11%. In a city of Bombay, when I'm buying a house, 11% goes out of my pocket towards purchase of house. So how you will assist a small person with limited resources to buy a house, and how a broker can function with hordes of taxes, where Government of India is my sleeping partner and I am a working partner with no income.
Okay.
Thank you. Thank you very much.
Okay, we have last two questions.
Sorry, I told Shaina I have no answer for that, but a sleeping partner cannot answer sitting here.